Hi everyone, today on No Stress Forex Trading, we're going to look at 5 things new, struggling, and even experienced traders need to remember in order to be profitable, stay profitable, and eliminate the stress in their trading. Number 1, the first thing I want to talk about is trading is not an exact science. If it was, there would be a magic formula that everybody could get and everyone would be profitable in trading. However, we have no control over this market. It does what it wants, and the only thing we can do is follow the flow of it, however we see fit. So, something that's important that you need to keep in mind is you have to give yourself room to be wrong. And with that, you need to understand that even if you just place a trade, just throw a random trade on your chart, it's a 50-50 chance that it's going to be right. You're going to have streaks of losing trades and you'll have some streaks of winning trades. But what's important is that it's okay to be wrong. If you focus solely on being right every time, you'll have too much emotion and too much stress involved in that particular trade to be able to make smart decisions on other trades or even in that position itself. So it's really important that you understand from the get-go that it's not an exact science. You need to give yourself room to be wrong, and that the winning streaks will come. You just have to give it time. With that, number 2 is to find your own perspective in the markets. And that just means how you view the markets, whether you like shorter time frames or whether you like longer time frames, or if this particular indicator helps you see the market differently, or what kind of mentor or teacher you follow in order to learn their perspective. And that's okay to learn someone else's perspective for a while, and just to see how the market works and how that flow of price movement occurs and how you see it. And so it's okay to adopt someone else's perspective for a while, but it's really important that with experience you gain your own perspective so you have more confidence in your trading and give you more of an ability to be confident in each trade. Whether that's right or wrong, you still have confidence in your decision. Number 3, experience trumps indicators every single time. There is not an indicator out there that will beat experience in watching charts and viewing price action and understanding why the price is moving the way it is. Indicators do help, don't get me wrong. The only indicators I really use are Fibonacci retracements. I may put a moving average on my charts from time to time, but for the most part my charts are really, really clean, and I find that's easiest for me to see the flow of price movement with a clean chart with simple Fibonacci retracement levels. Nothing fancy, it's clean, it doesn't clutter my vision, and for me that's what works best. You have to find what works best for you. A lot of times new traders or even struggling traders, because I've been through this myself, they'll try and find the perfect indicator that follows price to a T, and that it just doesn't exist. There's just not one, because indicators are lagging information. So the price has to move and the price has to do something before the indicator can print. So the indicator is always behind the price. Now, indicators do benefit and they are good tools to use, but to rely solely on indicators is really detrimental to your success as a trader, because it stops you from viewing what's happening in the market and you're only relying on the indicator's movement and not the price's movement, if that makes sense. Okay, the 4th thing I want to talk about is risk to reward ratios. And they are talked about extensively on online courses and other online material for trading, and even in hard copy books. They talk about a risk to reward ratio, and what they mean is that you need to have set for each trade a fitting relationship between your stops and your targets for each trade. So the risk to reward ratio for a 1 to 3 trade is going to give you a stop, say maybe 10 pips, and the target would be 30 pips. So that's 10 to 30, 1 to 3. That is important if you solely rely on statistics. And no stress Forex trading, I don't rely on statistics to be profitable. If I open a trade and it starts heading in my direction that I expect it to, and it starts to stall or show any type of consolidation or anything that makes me leery in the continuation of that trade, I will just close it, no questions asked. And the way I view that is if I have a strict risk to reward ratio, to me, it's like a river, okay? The market is a river. And if I have a set in stone risk to reward ratio, then that gives me a stop on the left bank and a target on the right bank. And I just throw my trade out there as if it's just an empty boat on a river. And it's gonna hit one bank or the other, and I have no control over that. I don't decide when to take profit or when to take my loss. It's strictly based on where I put my stop and where I put my target. Now, if I don't follow that strict risk-reward ratio and I use my own personal money management, which I will talk about more in future videos, but if I give my trade more room, it spreads those banks out in the river. And if I decide maybe I don't use my max risk on one trade, if a trade starts going against me and I haven't used my max risk, what I could do then is wait for support to be found again, and I could enter an additional trade to that position and help bring it back to a positive by averaging in. And that's not always the best move to make, but in some instances it is. And it's really up to experience to understand when the time is right to do that and when it's not right to do that. And another thing is, with my trading, I have a philosophy that I call see a dollar, pick it up. And when I visualize my perspective on the market, going back to number 2, my perspective on the market, I picture myself walking down the street and I see a dollar on the ground. Now, am I going to pick that dollar up, or am I going to wait and see if my 3 to 1 risk to reward ratio pops up and I find a $5 bill or a $10 bill, and just hoping that that $1 bill is going to increase to something else? So if I see a trade start to consolidate or find rejection at a certain level, I'm not going to just hope that my statistics pan out for me or that my risk to reward ratio is going to work out. I'm going to close that trade and take the money, because you don't know when a catastrophic event is going to happen, such as what has happened this past March, and the whole market is just going to completely turn on you. So that could happen at any point, and you want to make sure that you lock in the profits that you have made on those trades. So that's why I don't use a strict risk to reward ratio. I use my better judgment and experience from watching price movement on charts to really make that decision. And along with that, referring back to number 2 of my own perspective, something that was really instrumental to me in finding my personal perspective was reading the book Inventory Trading by Sean Campbell. And in this book, it talks about how each trade is a piece of inventory and how banks use those trades to build positions, and they'll look at it as bringing on inventory, and then at some point in time, they have to offload it at a profit. So if I have a strict risk to reward ratio, I'm not going to be able to hold that inventory as long as I would like, or I'm going to have to hold it longer than I would like, even though I decide how much profit I want to take on that trade. If I'm following a strict risk to reward ratio, that hinders me from having the freedom to run and manage my own inventory. So that's how I view each trade, is as a piece of inventory, and I decide if I'm willing to lose money on it or take profit on it, and how much I'm willing to do to either lose or win in each scenario. Now, number 5, the potential in small wins. And the person that I learned this from, his name is Rob Booker. And if you've learned about trading or been trading for a while, you've heard the name. And what he teaches his students in the beginning is, if you make $1, stop trading. Wait a week, open up your charts on Monday, make $1, stop trading. And what he's trying to teach is how to make money and keep it. Because that's the whole point of the game, is to make that dollar, keep it in your pocket. Find another dollar, put it in your pocket. So if you're shooting for 10, 20% gains per trade, that's just not going to happen consistently. But small trades can happen consistently, and with compounding, they can equate to a massive amount over the course of a year. And that's really what's important, is the long distant view for traders. Where are you headed? What are you shooting for the month or for the year? Not what you have to not what you feel like you have to make today. So understand the massive potential in small wins and how little bitty wins can add up to large returns over the course of time. If you missed the market analysis that I had for this week, I will leave a link to that video in the description. Otherwise, I appreciate you stopping and watching the video. And if you liked, subscribe, hit the like button, and we'll see you next time. Thanks.